Tech Teardown for Friday, November 15th. Let's get right to our first headline. Over the past couple months, activist investor Carl Icahn has been accumulating Apple shares and pushing for an aggressive buyback program. Funds are now disclosing their quarterly holdings in 13F filings, and investors now have some more detail on what Icahn's been up to.
So at the end of September, Icahn disclosed that he had about a $1.9 billion stake, which at the price at the time, that's about 3.9 million shares. Certainly since Apple's so enormous, that's less than 0.5% of ownership. Whereas Icahn generally likes to get big stakes to make activist changes. Harder with Apple. But right now, shares are actually up about $50 quarter to date. And he's also accumulated even more. In his letter to Tim Cook last month, he said he had about 4.7 million shares. So he's now got about $2.5 billion of the Mac maker.
Realistically, you mentioned that his stake isn't really big enough to let him be an activist investor. So is this important to investors? Should Apple investors care?
He can't do as much directly on his own, but he's still a very vocal guy, and he's certainly a guy that's it's nice to have him on your side. And at this point, we also have Apple investors have David Einhorn and Carl Icahn both sitting here pushing for more aggressive types of buybacks or other forms of returns of capital. Of course, Einhorn had his preferred idea, which probably won't go anywhere. But
right. So you mentioned David Einhorn and Carl Icahn. Why are activist investors being drawn to Apple?
I think that there's been so much controversy over Apple's just enormous, unreasonably enormous cash balance that they're really wanting people to wanting the company to return more, and in doing so they can, if they do it through buybacks, that can be accretive to earnings per share. I don't think that Einhorn or Icahn's specific proposals may be implemented. Einhorn's preferred is a little bit more complex. Apple prefers simplicity in pretty much everything, so his preferred idea might not go anywhere. Icahn's buyback is $150 billion. He's saying do it all in debt, which is enormous. I don't think that they would do it to that extent, but the point is really just they can afford to give more back, and if they can even do half of what these guys are proposing, that's still a big win for investors.
Would you want Apple to give more back?
Oh yeah, absolutely. I think that right now that cash is on their balance sheet is putting a drag on some of their metrics. For example, return on equity is artificially deflated because this huge cash balance, your equity figure is just enormous, and it doesn't really need to be. And at the same time, Apple's just investing in really safe things, so it's just sitting there. Of course, most of it is overseas, which is why they've been using debt to kind of tap into it in a roundabout way.
All right, let's move on to our next Apple headline. In various ways, Apple's position in the tablet market has deteriorated over the past couple years as the competition is catching up. Apple's still the top vendor, but unit share has now slipped below 30%. One analyst also took a closer look at the numbers. What'd she find?
So we're talking about Morgan Stanley analyst Katie Huberty, who's covered Apple a long time. And based on IDC's estimates of third quarter tablet volume, she now estimates that Android OEMs collectively are generating more revenue than Apple by a very slim margin, by about 1%. Android she has at 46.2%, iPads at 45.6%. So that's a really small margin there. Most of these gains are really driven by Samsung and Lenovo, who are really growing their unit shipments on the backs of these low-end models.
Should we be ringing the alarm? Is this an obviously negative storyline for Apple?
Well, I think that there's investors really need to look at a lot of different things, because there's many different ways to measure market share. There's unit market share, which as we mentioned has been coming down. Now there's revenue share, but there's also profit share, and most of these other companies aren't very profitable on their tablets because they sell them at lower prices. Samsung is profitable, but most of them aren't really generating a whole lot. Apple is very profitable because it has higher price points, has more pricing power, also has some cost advantages. But at the same time, a lot of people like to look at profit share, but it's really hard to get to any meaningful operating profit share because Apple organizationally doesn't have things allocated by product. So it's really hard to say, oh, their iPad operating profit is this, because they move people dynamically between functions, and it's just kind of an exercise in futility.
Do you think these numbers are going to be meaningful in another quarter? Do you think they're going to change at all?
I think they will, because of course third quarter shipments and revenue figures implied therein are all based on the quarter right before Apple's big launch, and everyone knew the launch was coming. So this quarter they should get a nice bounce back in terms of all of these metrics in unit and revenue terms, specifically with the new iPad Air and iPad Retina Minis coming out. The Retina Mini might again have some supply constraints, but right now they're shipping it, and right now the shipping times don't look that bad. It's just a couple of business days. So it seems like maybe Apple's ramping up production. Maybe they've tapped Samsung to help them out. But I think they'll bounce back.
All right. Let's take a look at some of Friday's movers and shakers. Mobile chip giant Qualcomm is rallying today to new 52-week highs. In fact, Qualcomm is now the highest it's been since the tech bubble over a decade ago. The stock has underperformed despite its strong position in mobile chips. Why do you think the price action is happening today?
So right now, you're right. Qualcomm is still underperforming the market. I mean, they're up 10% year to date, but the S&P 500 is up something like 25%. So they're still lagging. It's nice to see them kind of coming back and hitting these new highs, but in the grand scheme of things, they are still underperforming. I think that they've been kind of in a rut. They definitely went down earlier this month on earnings because there's some concern over guidance. But I think at the same time, that was kind of an overreaction. I think maybe investors are starting to realize that they kind of sold a little too quickly.
Do you like Qualcomm in this space? Is Qualcomm your favorite mobile chip maker?
It's the dominant mobile chip maker in terms of the most important ingredients in a mobile device, which are the applications processor and a baseband in the case of smartphones or cellular equipped iPad or tablets. I think that a lot of the skepticism around Qualcomm has been around the smartphones because obviously Qualcomm has been such a big smartphone player. And there's been so much concern over unit growth deceleration, so they're going to be kind of held back there. But also beyond deceleration, there's been a mix towards lower end models, and for Qualcomm's licensing business, the declining average selling prices will negatively impact its royalty revenue. So there's been all these things that are happening within the smartphone market that have really kind of had investors been a little bit skeptical, but I mean, Qualcomm's still at a very reasonable valuation. It's not like they're over.
So you like this stock moving forward?
Yeah, I've owned it for a long time. I've been a little frustrated that it's been kind of like lagging for so long, but I still believe in the company. I think they have a lot going for them. Another source of skepticism is just competition. NVIDIA is jumping in with Tegra 4i early next year. Intel's now shipping a multi-mode LTE baseband. There's competition, but I still like Qualcomm.
But realistically, Intel's pretty late to the party. Do you think Intel poses a real threat?
I think they pose more of a threat in tablets than they do on the smartphone side. Qualcomm has made a lot of tablet gains this year, getting a lot of good, nice wins with the new Nexus 7, new Kindle Fires, really growing their tablet share. But I think that's where Intel's trying to go with their processors, and they've become a lot more competitive in terms of price and power consumption. So I think that they've got some stuff going for them.
All right. Shares of music streamer Pandora have jumped to tap fresh all-time highs today. It's rallying in part thanks to some analyst notes. Could you tell us a bit about these?
So JP Morgan has boosted its price target from 25 to 35, reiterating an overweight rating. Analyst thinks that Pandora is about to hit a turning point in monetization as the company continues to grow its market share of the overall streaming market, as well as it's really ramping up its sales force to try to boost ad revenue. This actually comes following another bullish analyst note earlier this week from Needham. Also moved price target from 25 to 33. Again, also sees some opportunities in cars. And we also just saw some hedge fund filings from the third quarter. A lot of hedge funds are jumping in. Earnings are next week, so I think a lot of people are feeling pretty optimistic.
So there's a lot of good news surrounding Pandora right now. It is a somewhat controversial stock, though. It's a Motley Fool recommendation, but I know you're somewhat of a skeptic. What do you think of Pandora's valuation right now?
I have always been kind of skeptical about Pandora, primarily around its ability to scale, because since its cost structure is highly variable, it's really hard to ramp up revenue. I tend to like companies that have operating leverage, which is where the company has a high proportion of fixed costs to where margins will ramp with revenue. But Pandora's biggest costs are variable content costs, so it makes it really hard to really scale the business. At the same time, the flip side is that with operating leverage is that when you have a high percentage of fixed costs, it's good when times are good, but if the business starts coming down, it's hard to scale down those costs. Whereas if you have variable costs, you can actually pull back some of that spending when times are bad. But I think as they ramp up their ad sales, that could actually really help them try to scale the ad revenue faster than their content. I'm not bullish on them, but I'm a little less bearish, I guess you could say.
All right. Professional networker LinkedIn is ending the week on a happy note. Shares are up about 4% today. Who do investors have to thank for this?
Well, Stifel Nicolaus is the latest analyst to give some bullish voter confidence on LinkedIn, starting them at buy with a $300 price target. I think the real thing here is that the platform is really evolving beyond, in a lot of meaningful ways, beyond what the traditional job listing sites used to be. It's really becoming more than just like this online resume, which is what LinkedIn historically has just been. It's just some place to put your resume in a standardized format. But now they're really becoming a centralized hub where people really manage and enhance their career in all sorts of ways, and that really differentiates them from the previous previous job sites before. So I think there's a lot to be confident about.
LinkedIn recently sold off after earnings. Do you think investors overreacted?
I think they did because they, again, it was kind of guidance. They beat on the current quarter's figures, but then their guidance was a little bit light, so investors kind of freaked out and they, sold off. But if you, take a step back, they beat on one quarter and they're issuing a little bit light on next. It kind of offsets each other if you take a step back and look at the bigger picture. I think that, tying back to this differentiation argument, I think that, what they've really done really sets them apart, and they have all these social and network effects now that you can't really replicate that as easily as in the past.
So you feel like LinkedIn's got a pretty firmly established moat now?
Oh, I do, because if you look at those other sites of way back when, like Monster.com, and basically just a listing site,
right.
That's very easy to replicate. I mean, anyone can do that. But when you add in these other social aspects of it, and really, their big thing has always been to turn that into data that they can use. I think that they've really created a very unique platform, and even other social media companies like Facebook have tried to get into this professional side of it, and they can't.
All right. That's all for today on Tech Teardown. Want to learn more about the tech stocks we're investing in? Just send an email to cto@fool.com, and you'll receive our special free report on our Chief Technology Officer's favorite social stock. For Evan New, I'm Erin Kennedy, and we'll see you next time.